good morning, everyone. And yes, it's weekend in the air. Good to have every one of us in this session. I trust you are doing fine. I trust you are doing great. Today is kind of weekend, right? And I know it has really been a great week for every one of us. Kind of a little bit busy as my own end, and I'm sure that's how it has been at your own hand. So thank you so much for making it into this session. We really appreciate your commitment and we appreciate your dedication. So, you know how we used to get started, right? We just go straight to the point without wasting much of our time, while we expect our colleague to join us later. So, our wonderful sponsor, right? Supporters. Should I say sponsor or supporter? It's actually a sponsor, right? Because if he's actually working on a project in his company, I'm sure his 2 hours is worth around 2 million or 5 million or so. So it's good to have him in this our session. So time out with Victor on financial modeling bootcamp. A big thanks to our sponsor once again, the Brown Consulting. That's the company where I currently work as a financial modeler and a corporate trainer. And Microsoft, right? Because I belong to the Microsoft's most valuable professional community. And to our wonderful colleague Adedolamu, valuation analyst and valuation modeling at Deloitte, Nigeria. So I remember I told us about him the previous session, and we started with the uh, should I call that introduction to it. So today, let me just hand over the mic to him so that we can get started while we'll be doing the practical aspect of it. He was able to run us through the theoretical aspect of it. So today, let's get our hands on a practical part of it. I don't know. My own approach is I usually like learning the practical part of it. Then when I understand how that kind of play in the real life, I can now go back to reading books and it just kind of flew. So I'm like practical first, go back to theory. Like it's like you want to teach me how to drink water. I would prefer let me drink the water first. Then we can now go back to the book and start reading on how to drink water. So Adedolamu Shigelala, you have the floor. So let me stop sharing so that you can share your screen as well. Kindly confirm if you can hear me at your end.
Hi, Victor. Hi, everyone.
Yes. Good to have you.
So good morning, everyone. Sorry, Victor. It seems I cannot share.
Yeah, you can now. Kindly go ahead.
Okay. Uh, I believe everybody can hear me. Let me just share.
I can at my hand.
Let me just share this screen alone. So, can you see my screen? Can we see my screen?
Okay, yes.
Okay. Can we all hear me, please? I just need one or two people to confirm, just to be sure that we're on the same page.
Yes, I can. Yes, I can hear you.
Okay. So welcome on board, guys. Welcome on board. I think last week we have done justice to the explanation part of this class, and then I promised that last week, this week we just dive straight into the practical aspect. I was talking to Victor yesterday, and let me quickly apologize. Beforehand, not to be boastful, but I really need to be on another call by 11:30. It's a client call, so please, I would kind of rush this class. Not let me say rush, but of course I'll make it as simple as possible. And if you noticed, I've even started, I've even trying to go ahead and just trying to get value for our company and all that. So, but then I will still make sure I do proper explanation and possibly if you want to do practical as I'm going, we can all do that. The reason for me going ahead to do it is just because I want to make sure we end this class today, and then I can easily join my own call. Apologies for that. Let me just apologize in advance. Okay, so let's go straight into it. I believe we all have the model that Victor shared yesterday. If you have the model, can we please open our model? Because I want us to use the one Victor shared, not the one we built ourselves, because there is a slight update, and I want us to be on the same page as we are progressing. Can we all hear me?
So we can. Yes, we
Okay.
can.
Okay. So
Yes,
do we have?
yes, I can.
Okay, so do you have the model open, the one shared by Victor yesterday? I believe we all have it opened, yeah? So towards the end of the model, we'll see the sheet that it named val, and that's just where our valuation will start from. Before the sheet, before the val sheet, that's the model sheet, and then we just want to go into valuation. And please don't let us forget that this is not a real company. This is just an assumption. So I'm saying this because let's assume that we want to set up a real company. After, like Victor mentioned last week, that after building the model, you still go back to management, and you guys will just there are some things they will agree with, there's some things they won't agree with, and then you do a lot of adjustments. You try to do comparisons, and then you try to just make sure that your valuation is appropriate. But in this our case, we just assume the company, and then we are trying to put figures. So okay, how is their financials going to look like? So please, there may be some things that are not as it is in practice, just because this is just an assumption. Okay, so, and I told us last week also that for the purpose of this valuation, we focus mainly on the income approach. And then when I say income approach, I mean we'll be using mostly the discount a DCF model. And the reason for that is, of course, there are other models we can use. We have dividend model, we have other models, but the reason why we are using discount model in this case is because, of course, this is a new company, and we say we want to be using dividend model. We know what dividend model is. That means we are trying to get what is the dividend that this company would like to be paying to their investors. And of course, we don't have that information. So the best approach to just use in this case is just let's learn the basic DCF model. And I also mentioned that we may not be using the market approach, and I think I gave the reasons for that last week. Market approach has to do with, we must first of all establish our source of getting comparable companies, and of course we for the purpose of this class we don't have that privilege. In Deloitte, for instance, there is a platform where we usually go to. Of course, it is paid for. There are other companies to use Bloomberg. I mentioned that last week, so we don't have all this information for the purpose of this class. So let's just restrict our training to the income approach, and then let's use the valuation that we have. So now, when we are going to the income approach, I mentioned something last week, that this is more like a bank. This company, this Bootvest Limited, is more like a bank, and we are going to treat it as such. So we may want to have a sheet like this. Let me first of all hide everything I've done, so people will not start looking at, okay, what's the value, how do they arrive at this, so that we can all be on the same page. Okay, so are we together? Are we together? Okay, I assume
Yes,
that
yes.
all right, all right. Okay, so I also mentioned something last week. That for the fact that this is a bank, their PPE, as we know, we call it capital expenditure, is not as significant as that of other businesses. So we are looking at their balance sheet for other businesses, for instance, a manufacturing company, or a retail company. You see that before they can generate revenue, they need to they need to incur capital expenditure, probably. For example, manufacturing company, they need to buy a larger equipment, they need to, buy extra van for delivery. For them to generate revenue, they need to incur more capital expenditure, but that is not the case in a financial institution. For financial institution, all they need, most of the costs that they incur is largely deposits, and then the interest they give to their customers on deposits and all that. Trust me, okay, for example, a CUDA, you don't even know where a CUDA is, or most of this fintech, you can't even say they have branch in Lekki, they have branch in, whatever place they want to have it. But yet they still run a banking business. That's to prove the fact that for a bank, what they just the capital expenditure is not as significant as that of other companies. So the reason why you see, after getting, trying to get free cash flow, you see them taking out capital expenditure, and then, just to get the free cash flow that will go to equity holders. And I believe you all understand the rationale behind that thing. And the rationale is just to say that you are we are expecting to generate 1 million naira as cash flow, and then what cost do you need to incur? What capital expenditure do you need to incur to generate that 1 million naira? So let's say you are going to incur, of course we deal with changes here. I believe when I was running through the model, I saw Victor already doing something like changes in working capital when we were doing our cash flow statement in this place. So that's the same thing we do with capital expenditure. We deal with changes. Okay, last year you have expenditure asset worth 2 million, and this year you have assets worth 3 million. So the cash flow, additional expenditure you have incurred in that case is just 1 million. So that's the 1 million that will put in our forecast for the future period. And then of course any additional that we only deal with additions. I believe you all understand what I mean. So but for a bank, like I said, that is not the case. So after arriving at our cash flow, what do we do? There's something we refer to as capital adequacy ratio. Okay, so let's quickly start. Let's quickly just delve into this. I've done something. Yeah. So normally, since we have the three statement financial statement, so we can something where I can just pick my free cash flow from my net cash from operation. But because, like I mentioned earlier, because of the peculiarity of this particular company, Bootvest Limited, I can say that when we were building this model, we already considered a lot of things. Like the first one is this place we are saying we have EBITDA, and then in arriving at our EBITDA, I can see that we already then when we come here, there's this additional interest expense, and then we have another interest expense up here and all those things. Like I mentioned earlier, if this happens to be a real life scenario, or we have, so most of the things that we have in this would have been updated. Management would have told us so many information that will make us update this particular model. But this is not the case. So what I've done, instead of just jumping to free cash flow from operation, because I can see we have made so many adjustments when it comes to loan and advances, savings, and all those things. So what I've done is just to rely more on my profit or loss statements, and the reason is because I don't want to mislead us. I want to try to say, okay, let's do our own workings from our P or L statement. Because of the explanation I've given, because of the peculiarity of this our company, Bootvest Limited. Okay, so what I've done is to say, okay, now we want to use this safe approach. And another thing I need to mention, I think if I come here, I hope we can all see my screen. Can we all see my screen, please?
Yes, we can.
Yes.
Yes. So another thing that I've done, I can see that in our model we have something we call period count, and we are assuming it's just yearly, year 1, year 2, year 3, year 4, and the likes. So in for financial companies, financial services industry, they don't make their revenue. We usually don't assume that they make their revenue at the end of the year. So when we do a model evaluation like this, and we are doing, okay, year 1, year 2, year 3, the assumption is that assumption is not the reality. The assumption is that they are making. So the assumption is that we are recording their revenue as at the end of the year. But for financial service industry, in most cases, they can generate the way they generate their interest. They just generate, like, they generate interest on a daily basis. Sometimes they generate a million times on a daily basis. Yeah. So we can't, of course, for the purpose of our valuation, we can't just say, okay, we want to start counting, just like for every other businesses too. They make revenue anytime, but of course it can't be as rapid as that of the financial services. But so we can't say we just want to start counting. They make how many times did they make in one day, and then we then multiply that by the number of days in a year. No, that's not realistic. So what we try to do is to say, okay, don't let us put them on a yearly basis. Let us assume some we see some valuation experts, they will do, okay, let's assume that they record their this thing on a quarterly basis. Their, of course, their revenue, interest income, and all those things on a quarterly basis. Some will assume on half year basis. Some will, most times we usually don't see full year basis, and that is because of how they generate their interest income. We all know that so far that you, because of the loan you have with, let's say, First Bank, you are going to pay your interest, let's say, March, or monthly interest payment, or what have you. As you are paying on the 30th of this month, another person is paying on the 28th, another person is paying on the 27th, and like that. So what we try to do is to say, okay, you know what, to remove all those complications, let's just, for the purpose of this valuation, what I've done is to say, okay, let me just restrict their earnings to half year. That's why if you look at my own period here, you will see 0.5. You see, so this one is basically half year. Just say, okay, let me just be doing, okay, they are making it every half year. So by the time I get to year two, that means I'm saying, okay, they have made, you know, that's the assumption. Don't let me just go too deep into this because of our time. So the assumption is I don't want to use the basic one. Yeah, assuming I'm doing for a manufacturing or a retail business, I would have gone for the yearly 1, 2, 3. And if you all remember, some of us that have done something around annuity, the ordinary annuity, annuity due. Some of us we understand these things. How do companies how do they record their cash flow? So and that what I have now done is to say, okay, let me just go back. I don't want to name it EBITDA, but this figure is just the EBITDA we have here. And the reason I don't want to name it EBITDA is I think I've explained that last week. For a financial service industry, we usually don't see, especially a bank, in this our case, we usually don't see EBITDA because, of course, their earnings is their interest. So we usually, hello, can we still see my screen?
Yes, we can.
Okay.
Yes.
Yes.
All right. So their earnings is their EBITDA. So I don't want to use EBITDA. So in addition to that, what I've done is just to say, okay, now let me just unhide. Okay, so now what I've done, of course, we still have depreciation. So let me quickly say something about this depreciation. Yeah. So we said we really don't focus on the PPE for financial service, on the capital expenditure for financial services. So the only reason why I've adjusted this thing, okay, so what I'm saying to say, what I'm trying to say is this depreciation that we have here, the assumption is on additional capital expenditure you'll be incurring. Of course, you have to, the cost of it, the yearly cost of using this particular PPE to produce what you have produced is your depreciation. That's the assumption. So most times we usually don't take account of depreciation when we are doing valuation of a bank. We just go straight to, most times we use our profit or loss statement, and then we just go straight to EBIT, earnings before interest and tax. We adjust for tax, and then we move on. But what I have done here is to say, okay, because the depreciation that we have in this our worksheets and this our model is kind of significant. I'm saying when I'm looking at this, I'm assuming these are in billions. Let me just quickly confirm that. Uh, Okay, so they are in millions. Okay, yeah. Okay, so because this thing is significant, I just want to say, okay, don't let me overflog their cash flow, because if I do not take it out on the assumption that what I would rely more is adjustment for regulatory capital and not capital expenditure, I may not take it out. But because this one is kind of significant, I would just assume that, okay, don't let me assume that this is not a significant cash flow. Another reason, if I don't want to adjust it. Sorry, please give me a minute. I need to talk to, please, a minute. Apologies.
well done, everyone. Seems our presenter has a client call, right? You know how busy these guys can be, right? Saturday, Sunday, they are just on the job working here and there. So and I think we have to appreciate our man for making this time out for us. I was talking to him yesterday and he was telling me he has some client engagement today and the rest. So I just had to plead with him that you know what, you just have to complete this thing for us. So spare that time. All right. So well done, everyone. Well done. Well done. All right. Do you have any question regarding what we've done so far? Uh, and secondly, I also realized that most of us, I don't know, maybe we are not willing to uh, kind of uh, share on our respective LinkedIn profile about what you've actually gotten from this training. Right, right. What do you guys think? I would really appreciate if we are able to share one or two things, right? I think we are doing great things here. What do you guys think?
Okay, for me, Victor, good
Yes,
morning.
yes. Good morning,
So
Shay.
what I wanted to do was to wait till end of this training entirely,
Okay,
and then on my own, I'll then build the model from scratch. When I do that, and then I'll share it on my LinkedIn. That is actually my own plan.
okay.
I don't know for others.
That would be great. That would be great. That would be great. Thank you for that. Okay. Benga, your answer is okay. So Daniel said same as me. Okay, all right. Hi, Benga.
Hello, Victor. Yeah,
Yes.
hello.
How you
Yeah,
doing?
okay, good. Yeah, good morning. I'm good. And how are you too?
I'm good. I'm good. I'm good.
Okay, I did share something on my profile. I tagged you. I tagged Victor Ogunbele. I tagged TOWV, but I didn't see you react. So I just as probably did see it or
Are,
something.
are you sure you actually
I
asked me?
did,
If you did, I would definitely have attended to it. Okay. So maybe you need to check to be sure you
but for the
attended to
ones
it.
who've done already, at least we've been able to do that.
Yes. Okay. All right. Thank you for that. So one thing I also noticed is this that maybe after this our um valuation training, I might need to have maybe once last session, and the whole thing is all about how do you build scenario and sensitivity, cause looking at building a fintech, the reality part of it is you really cannot be 100% certain, right? And you build your model, you want to present it to your client is asking you what if this interest rate is um, lower than this, what if it is higher than this, if we decide to go below what is obtainable in the industry, what do you think will be our profitability stand? So you should be able to build that model that can still answer that question, right? Right, where you have a lot of scenarios, they have a lot of switches button that they can tap into, right? Maybe they can have some tax holiday. How does that affect the business cash? What if they delay the dividend payment for some period? How will that have influence on the business cash, right? If they decide to raise another form of investment, how does that kind of play? So you should be able to build that scenario and sensitivity, and that's more like the most important aspect of it when it comes to you building a model, right? You've understood everything, but how do you create that scenario? So we are saying, okay, what if our active users can grow by this? What if we are able to even do more than this? What if we are able to do below this? How would that have impact on our business? Okay, Adedolamu, seems you are back. Your screen is shaking. So I think we should have a session on that. What do you guys think?
Yes, I agree with you, Victor. Perfect. Cut.
Right.
Especially on sensitive analysis and scenario analysis.
Yeah.
It will be of great impact to us.
Yes, yes, and I think we didn't get to do our investment evaluation as well. Right, so building of your NPV, the project IRR, what will be the payback period, what will be the break even in sales, right? Building your free cash flow and the rest. I think those are the things we also need to take a look at, and then build sensitivity around it. What if this, how does that affect the investments, internal rate of return, the NPV, right? The cash flow to the equity, the cash flow to the firm as a whole. I think that would be a good one. What do you think? I think it will be great. Should we do that for free? Hmm. Should we do that for free? Okay, we are still contemplating on that, if that should be done for free, or we might end up charging just a penny for it. Right. Okay, all right. So while we wait for Adedolamu, can you confirm? I hope you are true. Client call can take time at times, right? They can keep on asking you the same question 10 times. You just have to be patient and keep giving the same response over and over. So well done. All right. So while we wait for him, let's just discuss concept of valuation. The truth is this: irrespective of the type of valuation you want to imbibe while building your model, valuation is what we do every day. I like breaking things down. So in fact, I will tell you that pricing is the same thing as valuation. Anybody agree with that? Pricing is the same thing as valuation. What do you think about that? Can anyone tell me what's your own understanding? Why do you think I said valuation is the same thing as a price of a product? Anyone? So right, I realize that most people usually take valuation on the high level of a thing, but I think we need to bring it down to a layman. And as a financial modeler, what makes you a unique and good financial modeler is your ability to be able to break things down for a layman, right? So I said valuation is the same thing as you pricing a product of something. Why do you think I say that? Okay, Ibrahim.
Yeah, yeah, good morning. So from my own perspective, I think evaluation is just showing the actual picture because if we are to observe from evaluation, we do take away some not some like okay, we remove capex, non-cash charges. So we actually need the actual worth of that business in terms of their product. So I can agree with you by saying okay, it's also the same thing as pricing.
Okay, all right, thank you for that. So Benga said the value you place on the product is the price you pay for it. I love that. Right? Anyone else? So this is one thing I want you to understand. When you hear anything like valuation, number one, know that valuation has nothing to do with the past. It has nothing to do with how the business have actually done. Yes, at times we might need to understand how the business have actually done in the past to be able to look at the future. But what if for a company that has no historical value, they have nothing, they've not even started, and someone is saying this business is worth $100 million, and people decide to believe it? That really sounds crazy, right? This business they've not been in existence. We understand the one that has been in existence, they have historical financials, but these guys, they've not even started anything. They don't have office, they don't have logo, they don't have anything, and you're telling me the business is worth 100 million. So valuation, most accountants usually find it difficult. The truth is, valuation has nothing to do with historical, which means you can actually value something that is not even in existence. And what do you think that is saying? Basically, it's all about cost and benefit. It's all about cost and benefit, which means valuation is just an estimation. In other words, estimation can either be right or wrong. Estimation can either be true or fair. Estimation is just to give us a base or a basis to making our decision. Let me give you a good example. Let me look for a product. Right? As I said, valuation is all about benefits and cost. Enter. Valuation is all about what? Benefits and costs. Let's assume I actually walk down into your office, and I'm carrying, let's say, a fan. Let's say Ox fan. I walked into your office and I'm telling you that, hey, I want to sell this Ox fan, and the value is, let me ask you, how much will you be willing to pay for an Ox fan? Let's say the medium size. How much will you be willing to pay for it? So in case you are not in
20,000.
so let's type in the chat box. So in case you are not in Nigeria, you can type it in your own currency. I believe you use fan in your country as well. So type it in the chat box. How much will you be willing to pay for that? Let me see. Okay, so Shegun is saying I can pay 20,000. Okay, Frankie is saying I can pay 15,000. I love that. Frankie is saying I can pay 15,000. Okay, good. How much will you be willing to pay for an ox fan? Because I just walk straight into your office and you see that product. How much will you be willing to pay? How much will you be willing to pay? Okay, so Binga is telling us first, I will consider the price of a new brand and discount by 30% to 50 because I will consider your as a fairly used. Okay, it's a brand new. It's a brand new. Still the same thing we see in the market, right? It's actually a brand new. It's a brand new. The whole story boils down to this: the fan that you want to buy. When I come into your office and you're telling me I can buy 20,000, I can buy this price, I can buy that. Remember this stuff will meeting me. The whole story is about what will be the benefit if I buy this one. Let's say there's it, you can always turn it on and the breeze just starts blowing, right? It can serve you over several years. So it's that benefit is the same thing as what we consider about a business, which becomes the cash aspect of it, right? So I don't want to take over the valuation class from you guys. Maybe we can have our own separate valuation. So let me try and reach out to our colleague so that I'm quite sure um is still with us, right? So that we can get necessary updates from you. Apologies about that. So let me while we wait for him, let me just be playing you guys some soft music. I hope that we do. Okay, right. Sorry,
Hello, my people. I'm so sorry. I had to quickly talk to my manager. Hello?
Okay, right. Good to have you back.
Hello?
Good to have you back.
Apologies. I'm so sorry. I had to quickly talk to my manager. It's regarding one client's call that we are supposed to have.
We understand.
Apologies.
We understand. We understand.
Okay. So let's quickly delve straight into what we are trying to do. So I was trying to explain the reason why I've removed depreciation, but another school of thought might argue to say, sorry, Victor, I wasn't listening to what you were saying. I don't know if you've tried to explain all this part.
No. Continue. We did not touch your part. We're having
Okay.
discussion.
Okay. So I would say I was trying to. Another school of thought might come to tell you that, say, since depreciation, which I sort of buy too. Another sort of thing I come to tell you that since the depreciation is not an actual expenses, it's not, it's just a provision. We're trying to provide for this, trying to provide. It's not as if we are spending, we are incurring any expenses as depreciation. So they can come to tell you that since depreciation is not a cash item, like so it's a non-cash. So why should we take it out and even as a net income, especially when we are not going to make adjustments for capital expenditure? So in that case, what I would do, I won't even bother to argue because they are actually correct. I also thought about it that same way, but the only reason why I've included it in this place, like I said earlier, is just because we already built it as part of our model and it is significant. But when we are doing a typical banking valuation, of course, in my own place of work, we usually don't bother ourselves with depreciation. We usually don't. We just go straight to use what they have projected. So going for let's now move on. So I think I explained the reason why I've not used this cash flow from operation here. And that is because there are so many adjustments here that if we are to look at it in a real sense, we have to, update. So are we all fine up to this extent? Because of course, I've taken out tax. So most of these things that you are seeing here, the tax that you have here, I just linked it back to what we already forecasted. So there is another way you can do it in a situation where you don't have a forecast or you don't have a comprehensive forecast like this and you want to use the CF. And of course, we can just assume your tax rate. So this company we are doing is a Nigerian company. I'm guessing it's registered in Nigeria, so you can just use Nigerian tax rate. Because of my small background, of my little background in tax, we need to understand that the tax in the financial statements, in the statements of comprehensive income or profit or loss statement, is not exactly what the company has paid. If you remember our accounting, there is always this rule that our financial statement is on accrual basis and not on cash basis. So remembering that, we know that the company would definitely put their tax expense as it is in the profit or loss statement. But when we go to the tax computation, that's when we now start seeing which is which. That's when we start saying which part is deferred tax, which part is the actual payments. That's when we start saying, so many breakdown of the tax. But for valuation purposes, because of course we can't say you should know valuation and before you can do valuation you must know tax. So what we typically do is just to say, okay, you know what, then let me stress myself on trying to get the actual cash payment for tax. I would just go ahead to use what we have, 30%. Of course, it's an assumption. We always put that as a caveat. But if management can provide, okay, so there was a time a colleague spoke to me. We were just talking about one valuation, and she was trying to ask about, okay, so the clients in that case, I think they were testing for impairment, and the impairment was marginal. I mean, so when we are doing valuation, we always try to do low end and high end, and which for modeling they call it scenarios. Like, okay, if you have this particular scenario, what will happen and all that. So when we do our sensitivity, because it's typical sensitivity analysis in Excel. When we do our sensitivity and then one part is impaired, one part on the low end is always usually impaired, and on the high end is not impaired. So the client was pushing back that no, they don't want to see any impairments, that what do we need to adjust. And when we are trying to say, okay, what can we adjust, we now say, okay, let's just drill down into the tax. And remember, the colleague was asking me that, okay, so if you want to get the actual cash payments, what do we do? And then in that situation, we had to start looking for, okay, give us your tax computation, let's see how we can work around this, let's see which one is the actual cash before, because the tax we have here is inclusive of both cash and non-cash. I mean, the accrual basis, the amounts they will pay and the amounts that will go into deferred tax. So that is just by the side. Okay, now this is the part. This, if you notice, this is my adjustment for regulatory capital. If you notice that I have not put anything here, this is the part. This part and the discount factor is the part that we really need to pay rapt attention. So what do we mean by sorry? So what do we mean by adjustment for regulatory capital? I think I mentioned it last week that for financial services, there's something we call capital adequacy ratio. So that capital adequacy ratio is simply trying to measure the level of risk that depositors face by transacting with this bank, and how the bank plans to mitigate that risk. So that capital adequacy ratio is simply talking about, okay, with your capital base. And you know that the asset of this, what's it called, of the bank, which is usually the loan they've given out, the this, the that, is deposit of somebody. So there is a risk that the person they've given the loan to may not pay back. And at the same time, depositors, of course, they don't care whether you're giving out the loan or if you whatever you have done with their own deposits is this. But anytime they come for their deposits, they must get it. So there is this risk that by giving out the loan, of course, when we are doing our for some of us that are into financial services, we know that there are times that banks will write off loan, despite the fact that they try as much as possible to recoup all their loans. But there are some situations where it happens that they can't do it. So now what they are trying to say is that, okay, we know that you'll be exposed as a bank, you're exposed to this type of risk, but your depositor, you still need to pay them. So there is a regulation by CBN that says, okay, you know what, you must have this. So this is not a loan to deposit ratio. It's adequacy ratio to say, okay, this is your level, this is the amount of capital that you have, and then this is the amount of exposure, risk exposure that you have. So let's try to do give or take, and then see the particular percentage of your capital that must cover your assets, your exposure. Do we understand what I mean? So your capital base, yeah, you have this as your capital base, and then you are exposed to this level of risk, the loans you've given out, the transactions you have done as a bank. Now, your capital that you have, what there's a percentage of this risk that your capital must cover. Let's say you've given out loan of, let's say, 2 billion, for instance, and then you have a capital base of, say, just an example, you have a capital base of, say, I want to see something that will give us around 30% of that 2 billion. So you have a capital base of, say, let's say 600 million. Do you understand? So that means that in that situation, if I think I'm correct, in that situation, you have your capital base can cover up to 20 or 30% of your risk exposure, which is your loan and some of the assets you've given out. So in arriving at this what's it called, at this capital base, there's a way we calculate our capital adequacy ratio. So there's something we call risk-weighted assets. There's something we call risk-weighted density. Okay, so let's quickly. I think we should do that part together, and then are we together? So this part. Okay, so I think we should do that part together, and let's try to see what the level of exposure of the company, because instead of, like I said earlier, instead of our capital expenditure, this is what will serve as our, what is it called, as our own capital expenditure. Do you get? Because as a bank, it's a requirement that you must meet for this level of exposure that you want to expose your clients to. So first thing we need to do is to say,
in progress.
okay, so the first thing we need to do,
stopped.
all right, so the first thing we need to do is to try to get our risk-weighted assets. So what we mean by our risk-weighted assets is, okay, the assets of the bank, we want to weigh them, we want to see, so the weighting we give to them will depend on the level of risk that we think they will have. Yeah. So what we'll do in this situation, based on our forecast, what we'll do is to first of all come back to, let's do, we want to do our risk with asset. Okay, so now what are the, now we come to our balance sheet. Where are the assets of the company, PP, loan and advances? Okay, so we have cash, all right. So now let's come back here. We say cash equivalent. We have, I think, let me just think it instead of typing. Okay, so we have loan and advances, then we have trade payables. Okay. Okay. So let's say we have weightings. Okay. Are we together up to this point? So what we are trying to do is, okay, we've said, okay, let me just do, okay. Okay, now let me first of all assign weightings. So, based on what we have been talking about so far, now we want to assign weightings to the assets of the bank of Bootvest Limited. Now, loan and advances, it is the asset that carries the highest risk. So we give it 100%. Sorry. Okay, so are we together? So what we are trying to do now is to say, sorry, I believe we are all familiar with all these my Excel shortcuts and what have you, because I'm not teaching Excel. Am I permitted to say that? Hello?
Yes, we can hear you. I can hear you.
Okay, so I think I'm not moving too fast. I hope, because of this, all these Excel shortcuts and locking and relative referencing, average referencing. I'm sure Victor would have mentioned something around that. So am I good to go? Am I not too fast?
Yes, fine.
Okay, all right. So what we typically do, what I've seen us do, is to say we assign the same level of risks to loan, trade, prepayment, and for cash. We usually don't give it any weighting, and I think we all know the reason for that. There's no risk exposure in cash, and cash, again, it is what you have with you. So we are not saying there's a risk. Of course, we are not talking about risk of theft and all these things. We're talking about risk of using your deposits to transact, and what the exposure will likely face. Okay, so we usually leave cash, as we don't assign any weightings to cash, and then we still come back here to say what are trade receivable. Okay, I'll do the same thing for this. Okay. So we don't have any cash from investment, loan, repayments. Okay, all right. So Okay. Okay. What we have done here is to say from our total assets, which ones are we likely to face what's it called risk are we exposed to risk. So what we have tried to do in that sense to say, okay, what is our risk weighted asset density. So of course our density is just our risk weighted asset over total assets. Now that is the one aspect of calculating our capital adequacy ratio. And then there's another aspect where we have to start we have to estimate our qualifying capital. Don't forget what I said earlier is what we are trying to get here is to say for this level of assets, for this level of, by giving out loan, bank is generating revenue. So for this level of asset we want to have, what is the amount of capital that we are required to have. So in estimating our qualifying capital, we need to know there's something we call tier one capital and there's something we call tier two capital. So tier one capital is simply saying that the capitals that are majorly from shareholders, and then the tier two capital is any other additional capital. So let's go to tier one capital. Okay, so let's just skip this. I mentioned something last week that we usually don't have much tier two, we have mainly tier one. Okay, so I mentioned something last week that for banks it is highly balance sheet driven, while for most other businesses they are more of what's it called, uh, profit or loss statements. But for banks, like I said, it's whatever they have in their balance sheet that will drive whatever revenue or costs they will incur. If they have too much liability, so if they have too much liability, we already know the effect of that. That means they have, when I say too much liability, they are receiving so many deposits than the loans they are giving out. In that situation, they will most likely have negative net interest income because the interest expenses they'll be paying on their deposits will be higher than the interest income they're generating from their revenue. So that's why I said for banks, we start by when we want to do any analysis for them, we start by looking at their balance sheets. This thing, and the same principle applies here. We can see that before we arrive at our risk-weighted assets, what we are simply focusing on majorly is the balance sheet. Okay, so this capital do we have?
gbogbo ẹ̀ mò ń sọ 8k ẹ̀gbọ́n ẹ má má gègé sẹ́yìn ìlú lágbára gan.
So for if it is let me quickly say this again, that if this is a proper company, I mean probably a company that is already existing or something, there are other stocks that will be in their equity, something such as reserve, something, there are other things that will form part of their shareholders capital. So those are the type of things that we categorize under tier 2, under tier 2, what do we have, tier 2 capital. But in this situation, for example, borrowings, reserve and all those things. But in this our case, what we have majorly is just share capital and retained earnings. So what will now constitute our tier 2 capital is if they have borrowings. So these borrowings in this case, we are not talking about deposits. These borrowings in this case will be probably loan from another bank, to finance their business, loan from banks too, they get loans. So loans from CBN, stuff like that, and every other thing that we may have. For example, we have other comprehensive income from other comprehensive. This retained earnings is different from the other comprehensive income. So we have other comprehensive income such as if you remember our IAS, some of us that do accounting, IAS means International Accounting Standard. There are some things that will go under other comprehensive income. I wouldn't want to start mentioning that because we are not. This class is more for IAS standard. So things like that, we form our tier 2 capital. So this case, our tier 1 capital, the total tier 1 capital is equals to okay. Now let's go to tier 2. So if we want to learn more about this, I would suggest we try to read more about this tier 1, tier 2. I'm so sorry that I'm rushing. I should have I know I should have done more work when it comes to this tier 1, tier 2, because this is the major part of valuation of a bank. This is the reason why it is different from every other company. But please, I would advise, if we want to just learn more about this banking valuation, we should try to read more about this capital adequacy ratio. Apologies, I can't really delve so much into it, and apologies that I'm sort of rushing. So we have long-term borrowings. Okay. Because this borrowing, I'm bringing these borrowings because, of course, it forms part of the source of finance of the business. I think borrowing is the only thing we have as tier 2. Let me see. All these ones are non-current. Okay. So I think the only thing we have as tier 2 is just borrowings.
Sorry, hello, Adedolamu.
Yes, please, I'm with you.
Yeah. Sorry for taking us back.
Okay.
Is there any difference between the risk asset weighted or risk weighted assets and then the total asset? Because from what I'm
what?
Can you hear me?
Yes, please. Risk weighted asset and what?
The total assets. The risk weighted asset and total asset. But from what I'm seeing, I can see the only difference is cash and cash equivalent. I want to confirm if it's peculiar to financial sector alone or is this across board?
So this is not. This is just for financial services. For manufacturing or every other business, we don't even need to start budgeting our assets with capital adequacy ratio or whatever we are trying to arrive at. Now, like I mentioned it earlier, the only reason why this is seeming like the only difference is the cash is because of our model. So if you look at our model. When we look at our model balance sheet in our model, we can see that everything we have under our total assets, we really don't have much. We really don't have much. All we just have is PPE, loan and advances, prepayment. So there are some what's it called? Financial statement that we see, for example, we see something like a deferred tax asset. We see something like there are some other things that will constitute the balance sheet. In that situation, for example, we are doing evaluation for a first bank, for instance. When we take the financial statement of a first bank, it will be the balance sheet will be very comprehensive. We'll see all those we see some things in their assets. We see things that are more than this. For example, deferred tax assets, for instance, we won't allocate, even if we are going to put any weightings on it, we won't give it 100% weightings, because it is really not affecting our revenue drive. Deferred tax asset, deferred tax liability, those ones are just their tax terminologies, and I believe we understand the difference between deferred tax assets and current income tax assets and all those things. So their tax terminology. So in that situation, for example, deferred tax assets, I'm to assign a weight to it, because when I look at it, is it really making any impact on the company? The answer is, I mean, when I say on the company, I mean in their revenue generation. No, it's not really significant. It's not really making any impact. So the best weighting I will give to it in this place will probably be a 20%. If I'm giving a 20% weighting to it, you know that the difference of 80% would affect what we have here as the difference between risk-weighted assets and total assets. So when we are doing risk-weighted assets, we also need to think about, okay, all these assets I'm seeing in these financials, how are they affecting the financial performance of the bank itself? So the reason why for cash, for example, what we have done is not as if we are not considering cash as assets, but what we have done is simply to say that we are not facing any risk because we have cash. No, cash is not, we are not exposing ourselves to any risk. So that's why we are assigning a zero weighting. So what you see most times is you see companies or some valuation experts, they will list all the assets of the bank under this restricted assets. You now start assigning weights. So it's the weights that will form the difference. So where you assign 20%, of course you know that what you have in your balance sheet and what you have under your risk-weighted assets will be different. Where you have signed a 0% weighting, it will be, that means you are assuming that you are not facing any risk by having this asset. So that's the whole terminology behind it. So it's not just this is not a template. It's not just a one size fits all. You have to look at your financials and at your statement of financial position before you know, okay, what weighting should I assign to this? What weighting should I not assign to this? For instance, this prepayment, you will see, I think I've seen another company's valuation where they did prepayments. They assigned, I think, a 50% weighting to prepayment, and of course, when by the time they give you their own justification, you see that, okay, they have a point. And then, but what we typically do is prepayment, all those things, we just give it 100% weighting, because of course you are still exposed to risk. What if anything happens and you're able to meet up with this obligation? So that's why we usually give a 100% to it. I hope I'm correct. I hope I answered your question.
Yes, thank you.
All right. So that's the whole idea behind it. So for this one, so our total qualifying capital is okay. So our capital adequacy ratio is this. So our capital adequacy ratio is simply trying to say that what percentage of our capital will cover our risk exposure. I hope we understand what I'm saying here. So now this is what will determine the amount of capital we still need to invest in to be able to generate this amount of revenue or to have this level of assets. So according to, I think, Nigerian Nigerian regulation says 15%. Now we can see, I mean regulation, I say regulation, I mean CBN regulation. If you have, if your capital, I mean your capital base, your shareholders fund, your borrowings and all that, if it can cover up to 15% of the risk-weighted assets of the bank, then you are fine. But in as a bank, you are fine. So that's the assumption is that you are not taking much, you are not taking on too much risk, in terms of the loan you are giving out and other risk-weighted assets. So that, but in a situation whereby the regulation is saying you should do 50%, just an example. The regulation is saying you should do 50%, and look at this situation. We can see that in year 2021, just an example, in 2022 and 2023, they are doing above 50%. In 2024 and 2026, they are doing less than 50%. That is to tell us that they still need to invest in additional capital to make up this 50%. So that investment that they will do is what we bring back, is what we bring to this our DCF, this place, this adjustment for regulatory capital. So in this situation, okay, let me just go ahead. So I don't want to complicate this thing too much. What I'm trying to say is, in Nigeria, it is 15%. So I think 15% is what we have seen so far. Probably they come tomorrow, let's say CBN comes tomorrow and say that, okay, because of the situation of the economy, they feel like the banks should have higher capital base, to cover their risk exposure and all that. And they increase the adequacy ratio to less than something around 30%. We know that this our rise vest, for instance, they are covered up to year 2025. But 2026 and from year 2026 going forward, they will need to invest in additional capital to make it up to that 50%. So what that is, then we know that in that situation, in this our adjustment for regulatory capital, the difference between the 27% that they have now and the 30% required by the bank is what will bring 30% required by CBN is what will bring here as the adjustment for regulatory capital. But I don't want to complicate it because that is not the reality. The reality is 50%. I mean 15%. And what they have done so far in our forecast, we can see that they would do more than in all the years based on our forecast. We see that, okay, we are assuming that they will cover the capital adequacy ratio is sufficient enough to cover their level of risk. In this situation, what we have is, so in this situation, what we have here, instead of it being negative, will now be positive. Just like capital expenditure that I was explaining earlier, when they are incurring more capital expenditure, that means more cash is flowing out from the bank. Yeah, so it will be negative here. But in this situation, we are saying that, see, this company, they have more than what, let me just put regulatory requirements here. Regulatory requirements is 15%. Yeah. So what we are saying is, so please bear in mind that if this is a real life situation, we are still going to make a lot of adjustments to our model. So what this is trying to tell us is that this bank, they have more than enough capital. Now, what we will now do in that instance, so what is the difference between this and this? So we are saying they have 40% difference. So this figure that we have here will come into this our DCF, model. And of course, by the time this is coming in, of course, you can see what is happening. The equity value of the company is going higher. And we all know the reason. Instead of this being a negative, because they invest in more capital, they will have to, generate more capital to be able to get that level of assets. But in this case, that is not the case. What we have here is the fact that they already have enough capital, so they are in a positive position. They are good. They are covered. So that's to say that, okay, they have more cash flow instead of outflow. They have more cash inflow. Now, another thing we need to mention is, let's say we are doing this valuation for a company that has been in existence for, let's say, 4 years or 5 years historical. What we do is, instead of just coming to say this is our assumption, and then we know that their capital adequacy ratio is 61%, 50 something percent. What we do is we try to see what the capital adequacy ratio is historically. Let's say historically they've been doing 30%, 32%, 30 something percent. We look for the average of the historical, and then this future we restrict it to average of what they have been doing historically. So sometimes you just look at this bank, maybe they have a policy of, say, okay, although the regulatory environment is saying, the regulatory body is saying that we should be doing 15%, but internally, for example, an Eco Bank or whatever bank we have, their policy is to say we don't want to go below 30%. Of course, we all know the reason why. They say that they are saying they don't want to go below 30%, which is like times 2 of what regulatory requirement is saying. Now, instead of relying on regulatory requirements to make our adjustments, we typically rely on historical, and that will be based on what the company has been doing historically. I think we all understand it, but that will be based on what the company has been doing. Say, instead of using regulatory requirements, let's just do what the company has been doing historically, and looking at that, we use that as the basis to know whether there is any adjustment for regulatory capital. But in a situation whereby the policy of the company is to say, of the bank is to say they'll be doing 30%, and the forecast is saying they'll be doing 20%, and there is nothing to back it up, to back up that 20%, nothing like a board approval to say they want to reduce their capital adequacy ratio to 20% or to 25%, or any management circular to back that up. Of course, we have to adjust that 25%, that 20-25% that they forecast to what they have been doing historically, which is 31%, 32%, and whatever average we have historically. And like, just to buttress again, when we are doing valuation, we must always be in pari passu with management. I'm not saying we should do what management wants. I'm just saying that we must always let them know that this is the situation on ground. Is there any approval you have for this particular situation? Is there any reason why you have done this like this? Because those are the things that will form the basis of our evaluation. So going forward, now another thing we need to, I think there's no any question on this capital adequacy ratio before I move to, because this is the major part in the evaluation of a bank. Every other thing I think you're already familiar with.
Yes, I have a question.
Okay, please.
So you mentioned that it is whereby banks CAR it's higher than what CBN has as policy. That in that case you choose the bank's policy, and that's from what we used to determine the value of the company. Wouldn't that not be counterproductive whereby the bank has a higher CAR policy, and then eventually drive the value?
Exactly what
I don't think it's counterproductive for the bank.
Yes, you are. No, you are right. You are right. So it's in that situation, it will affect the bank negatively. So what I'm saying is this. I gave an instance where I said, okay, CBN policy is 15%. The bank's internal policy is 30%. So what you see in practice is the bank will not tell you their policy is 30%, because of course they already know that it will have an adverse effect on their valuation. They will not tell you, but whereby you see, so they will expect you to just rely on what CBN has given, and then use that as your basis. But in a situation whereby they now reduce their this thing to 20%. Let's say they've now agreed that going forward they'll be doing 20%. That is 5% higher than what CBN said. We are not going to penalize the bank in that situation. I mean, when I say penalize, we are not going to. It's not going to have any adverse effect on the bank. We are going to use their 20% as it is. We are not going to make any negative adjustments, because that way their 20% is even still higher than CBN's 15%. But when we doing our forecast, and we realize that their CAR is coming below 10%, or is like around 10%, or between 10% and 15%. Of course, that will penalize the company to say, at least if you cannot do what you have been doing historically, at least you must do what the regulation has required you to do. So that's the situation where we penalize. But where they said, okay, we are still reducing 20%. Of course, looking at it, they are still fine based on CBN regulation in that situation. But the reason why I said we look at historical is to say that this is what you have been doing historically, and there is nothing that there is no approval, there is no suggestion, there's nothing that is suggesting that you guys are to reduce your capital adequacy ratio. But after speaking with management and let them know that okay, this is the situation on ground, although right now you are still doing above regulatory requirements, but below what you have done historically. By normal regulation standard, normal valuation standard, we think you are fine. But what do you think? Why are you not doing? Why have you suggested that you be doing below what you have done historically? Now, management will give us the explanation. Is the explanation that will form the basis of what we will do in our evaluation. If they are saying, that's what they feel will be doing in the future, and they are still above regulatory requirements, so there is no, we shouldn't penalize them. Of course, I mean, when I say penalize, I mean we shouldn't make it have a negative effect on the evaluation. Why not? We leave it as it is. We won't affect them. But when they say that it's because they feel like in the future something will happen to their capital, and they think it will, management will come up with all sorts of story, and from your own assessment, from your own judgment, you can see that, oh boy, this business will be shaking. The best thing is for them to just push their capital adequacy ratio back to 30%, and in that situation it will have an adverse effect. I told us in the first class that valuation is purely an art, is depending on the information you are getting. That is what we feed into the valuation you are doing. Do you understand that? I hope I've answered your question.
Yes, sir.
All right. So now,
please, I have a question also.
Okay. Please go ahead.
Okay, please, regarding this regarding this capital adequacy ratio, is it because we are dealing with a fintech company, and that is why we are talking about this capital adequacy ratio? Let's say, for instance, we are dealing with a manufacturing company, we are trying to value the company. Is there any regulatory capital also that we are going to be talking about?
No. I said it earlier. If you are dealing with any other company apart from financial services, financial services, they are highly regulated by CBN, by SEC, and all those things. And because of the level of risk that they face. So if you remember what happened in 2018, I think the Enron and the whole thing that happened in the US, that regulatory authorities, regulatory bodies, they have been so particular about banks. Can we all hear me? Victor, can you hear me? Hello?
Yes, I can hear you.
All right. So now they have been so particular about banks. So what they now do is you must have this level of capital. They know that banks and other most financial services, what is driving their revenue is not the capital expenditure or what have you. So the only thing that is capital in nature that will drive them is their capital base. If you remember that, I think when during Obasanjo's regime in Nigeria, they increase the capital base, depending on the kind of services you are doing, commercial banks, retail bank, investment bank, and all that. I think they increased the capital base of banks to like 250 million. I mean, is it million or 25 billion? Yeah, 25 billion naira that you must have with CBN. And the reason for doing that is because of the level of risk we are facing. If anything should happen to your bank, will you still have enough capital base to pay back your depositors? That's the whole essence of this capital adequacy ratio. And because their revenue is not driven by capital expenditure, it's driven by what do you have? Are you meeting up with your regulatory requirements? So, for example, in a situation whereby there is a bank that does not have up to 25 billion with CBN, and they are saying they are having depositors deposits that is worth billions of naira. The level of exposure, the risk exposure in that situation is too high. So what they are trying to do in that sense is that there is a regulatory requirement that you must meet, which is like a cost to you. But for manufacturing companies, there is no regulation to say you want to start producing a cement, for instance, you must have this certain level of capital. What you just need to do is, if your investors are fine with it, if your borrowers will be getting loans from bank now, if they are fine with your whatever capital you have from your equity holders, there is nothing stopping you from running your business. What will drive your business in that situation is your capital expenditure. To say, before you will make 1 naira, you must have invested in machinery that is worth 1 million. Do you understand what I'm trying to say? So in that instance, so the company is now saying in year 2, they are planning that they will start making 10 naira, and then the capital expenditure that they have in year 1 is only 1 million, and you want to make 10 naira in year 2, whereby you are making 1 naira in year 1. Before you can make that 10 naira, you must invest in additional capital expenditure. When I say capital expenditure, in this case, I mean PPE. Let's say you need to probably expand your production base, and thereby you need to buy additional equipment. So that additional equipment, for you to generate that 10 naira, you must buy an additional equipment of say 2 million. So that addition will flow, because it's an outflow. That kind of expenses will flow into our valuation, and that's where we now take cognizance of capital expenditure. But for banks, they don't, their revenue is not driven by it. Just get it. For example, like now with the advent of this fintech, we can see that this is the truth about banks. They really don't need any traditional banking, yes. But going forward now, we can see that banks, they don't need any structure. What they just need to do is, they don't need any major equipment. They can sit in the comfort of their house and start running a bank. Do you understand? In as much as they are meeting the regulatory requirement. Do you understand? So that regulatory requirement is the standard for them, unlike manufacturing, which is their capital expenditure. Do we get?
Yes, thank you very much.
All right. So as now let's quickly talk about this other aspect that I think we also need to talk about, we really need to look at, and that is the discount rate. Oh, sorry, I forgot to mention something about terminal growth rate. Now there is a logic behind terminal growth rate. And most people just think that when you are doing valuation, you pick terminal growth rate based on what have you. I think Victor would have mentioned it when we are reading our model. So the idea is this. Look at the company, for example, our rice vest. What they are doing is it's a bank, and then they are operating in Nigeria. Do we get that? Now the idea is, this may be wrong, but the basic idea is, no company will grow higher than the country's GDP, the GDP of the country where they are operating in. It's an assumption. It may be wrong. You can see companies that are doing way above the GDP. But the basic assumption is, the maximum you can do is to say you want to do what the forecast GDP growth rate will be. Now, there's something that we also need to consider about. Is either we use GDP growth rate or we use inflation. In a situation where the GDP growth rate is lower than inflation, the forecast inflation rate, what we do is we go to inflation to say, okay, this is the level of inflation in this country. And then in that situation, we want to restrict. We say, okay, you are saying we grow by why? If you look at forecast of a company, you see so many. Do you say this is just an assumption? So what would you going forward? Hello.
Hello, we can hear you now.
Okay, we can hear you.
All right.
So, your screen is not showing.
Okay, so
I think the network was.
can you see my screen?
No, you need to
But we can't see your screen.
share it.
Okay, let me reshare. Okay, sorry, apologies. So what I was trying to say is to say there is another model we can use apart from inflation, Okay. Apart from inflation and GDP growth rate, we can say we want to use Gordon's growth model, but most times Gordon's growth model is usually way higher. For example, we have inflation of 11%, we have GDP of let's say 10, 15%, and then by the time you are doing your Gordon's growth model, that one is showing that it's showing your future growth to be at 30%, 35%. If you use that kind of model to say, okay, if you use that kind of terminal growth rate to value your company, every single person that is looking at that model will be like, why is your terminal value so high? Why is your terminal growth rate so high? And then you now start saying, because of this, because of this, they will now tell you that, okay, see, this company is operating this type of economy. The best you can do is just restrict them to inflation rate or restrict them to GP. Nominal GDP. So that in that situation, you know that you are not overvaluing the company. But because by the situation where you now use Gordon's growth model, and then you are using high rates for your terminal value, in that situation, you are likely to overvalue the company. So that's just the basic idea. So now let's quickly go to this discount factor, which is where we spent a lot of our time last week. So this discount factor, like I mentioned, we are doing this valuation for a bank. Assuming we are doing this for a manufacturing company, we would have used WAC. I think I explained that last week. And now we are doing it for a bank. Now the whole idea is this: we want to calculate what their discount rate will be. And somebody asked the question around CAPM yesterday, and then I remember I mentioned, we know, of course, I believe most of us know the formula of CAPM, which is risk-free rate plus equity risk premium multiplied by beta. That's our CAPM. But there is, I mentioned something around, trying to, when we are doing valuation, we're trying to, consider the impact of size. We're trying to consider the impact of risk that are specific to this company. We're trying to consider the impact of, inflation, country risk premium, and all those things. And in that situation, we go ahead to modify our CAPM formula, and then we call it modified CAPM. Now, when we are doing valuation for companies that have historical figures, historical financials, what we can do, I think I explained this last week, is to say, okay, instead of applying specific risk premium or whatever premium we want to apply, let's just sensitize their forecast. But in this our case, we cannot sensitize the forecast because we don't have historical information. So the best we can do is to apply a specific risk premium to our discount rates, to adjust our discount rates for a specific risk premium. Now, if you notice something, risk-free rates. So when we are talking about risk-free rates, of course, it has to be the longest yield we can get. So when we are saying risk-free rate is simply saying that the assumption is the only financial instrument that is risk-free is usually government bond or government bond. The assumption is government will always pay back its debt. That's the assumption. It may not be true, but that's the assumption. So now, that is the risk rate we usually use. Now, if you notice something in this my own formula, you notice that I have used US risk-free rate. So there we have a source. There is a source to generate that. So we have this. If you go to US Treasury, you can easily get that online. You go to US Treasury, you will see their forecast 30-year yield. So when I say 30-year yield, the rate on 30-year bond, government bond. So now the reason why I've used US is because of the current situation of Nigerian economy. We can see that the inflation rate in Nigeria is just the way it is moving. We can also say, okay, Nigeria is a good economy to get the risk-free rate. They can come tomorrow to say because of so and so and so and so, the CBN will need to adjust the rate. They will need to adjust government rates. So what we typically do to save ourselves from all those stress, to say, okay, let's go to a more stable economy. Let's go to US. Of course, we know that all this international trade they are done in USD. So what we typically do is to say, okay, let's go to US. Let's use US rates. Using US rates, what we now do is to say, after we have done all our, trying to using our CAPM formula, we arrive at a cost of equity. So the cost of equity will arrive at that situation will be the US cost of equity. Then we now bring it back to Naira. We bring it back to Nigeria to say, okay, now let's adjust whatever figure we have with the inflation rate differential. What's the inflation rate in US? What is the inflation rate in Nigeria? Whatever differential, we adjust our cost of equity. So that's the simple thing I've done. So because of our time, apologies once again. I cannot start. There's another way we can arrive at better using comparable companies and all those things, but I cannot start doing that. So in order to save us the time, there is a particular professor that we valuation experts we usually rely on his database. His name is Professor Damodaran. Victor knows about him. So he's like an authority when it comes to valuation. So what we just do is to say, okay, you know what? Okay, so we in Deloitte we have done something. For example, when we are trying to value a bank, we have tried to do comparable companies. We have tried to look at better of comparable companies, and then we have tried to average it. So what we have been getting so far for comparable companies in Nigeria in the financial services sector, what we have been getting so far is by the time we average their beta, we usually arrive at something around between 0.81 to 0.85, 0.86. And then when we look at Damodaran, we saw that okay, Damodaran is saying hello?
Okay, hello.
Yeah, we can hear you. We lost you for a
I can
while.
hear you now. Hello, Adedolamu. Seems your network is shaking. We can hear you, Adedolamu. Hello, Adedolamu. This
Hello, Victor,
okay.
can you hear me?
Yes, we can hear you now. We can hear you.
Okay, can you see my
Yes, we
screen?
can see it.
Okay. All right. So I was trying to say that. So in order to save us the stress of trying to go to um so in order to save the stress of trying to go to trying to get what's the trying to arrive at beta, since we have done comparable analysis before, we just most times rely on beta from Damodaran. But when we are doing our work and then we are sending for review, probably a review in US, reviewer in US or reviewer in South Africa, the first thing they will ask you is to say that okay, we agree with the beta you have used, but please try to do comparisons with what the industry beta is in your country. If the industry beta is in your country is worse, then or is better, they will ask you to rely on your industry on the industry beta in your country. So to save us the stress, we have gone to have used Damodaran, and then equity risk premium. I believe we all know what equity risk premium is. That's just the um, market risk minus risk free. So what we are trying to arrive at, look, are we together? So what we are trying to arrive at in this situation is to say that okay, this is the risk free, but because equity holders they will ask for additional premium for taking on this level of risk. And of course, we all know what equity holder is. We all know that they are exposed to the highest level of risk by investing in the company. So what we usually do is to say what they typically do. I'm trying to just explain KPM is to say, please give us additional premium for investing in your company. If government is giving 12% as risk free, because you are a company and there is a risk of default being a company, they will ask for more premium. That is what the equity risk premium is trying to take care of, trying to look at market risk minus the risk free. Whatever the difference is, what the investors will typically ask you to give them as premium. Now, because of this our situation, and then by the time we do all those equity risk free premium and better, by the time we arrive at our CAPM, which is the typical cost of equity. But we still go ahead to adjust for size. We go ahead to adjust for size for specific risk premium. And I think I explained the reason for this in our last valuation. Now, my size premium, different companies have different size premium. But in this my case, I've used Deloitte advisory size premium. But what I've noticed is I think I've seen that of PwC. I think it is also within the same range. So the way they arrive at SaaS premium is to say what is the market cap of your company, and then they say companies that are between 1 billion to 2 billion. This is their size premium. Companies that are between 10 billion to 6. They just try to categorize companies into large companies, micro companies, and then medium companies. They try to categorize companies based on their market capitalization, I mean. So when they do that, they arrive at premium. So because of this, our specific situation, I have used the least size premium because it's a new company. We don't expect their market cap to be skyrocketing. So that's why we have high size premium of 3.8. Assuming it's a matured company, you can see that their size premium may not be more than 1.5, sometimes 1%, sometimes even less than 1%, depending on the historical performance of the company. So I've used the list of 3.8. Now, for specific risk premium, I've not included any specific risk premium on the assumption, like I mentioned earlier, on the assumption that if it is a real company, what we would have done is to say we'll adjust their forecasts. And I also mentioned earlier that when we are doing evaluation, I don't want us to get used to every cost of equity you are doing, every cost of equity you are doing, you must include a specific risk premium, because that is not always the case. So it will depend on what management is saying and on what the forecast is saying. If you feel like the forecast is reasonable enough, by the time you look at the forecast of the company and then you compare with the forecast of the industry, if it is reasonable enough, you don't need to include any specific risk premium. But by the time you're looking at it and that situation is getting higher than what you feel that what the other companies are doing or than what historical is saying, then you can include a specific risk premium. So in this my case, I have assumed that our forecast has been we have reviewed our forecast with management, and then we have compared it with what they are doing in the industry, because based on what I've seen in our model, I think industries are even performing way higher than what we have forecasted. I mean, we look at the likes of Piggyverse, look at the likes of Kuda, look at the likes of Cowrywise. I think they are performing better than what we have forecasted. So there's no need to include a specific risk premium. So by the time we do all that, so the specific risk premium and the size premium, we arrived at 13.5 as cost of equity. But this cost of equity that we have arrived at is not for Nigeria, it is for US, because the risk-free rate we have used is for US. So now we still need to adjust with inflation differential. Most times, I think there was a time I was reviewing a banking valuation with my manager, and then I think my cost of equity was, I think, 25%. She was of the opinion that no, that is way too low, that it should be around 28%, and given the situation at the time. So of course we adjusted, and we adjusted the cost of equity, and then we arrived at what it would look like. Sometimes, in order to save us this stress, we're trying to look at, you can just go to Damodaron and pick a cost of equity. So there's something we call industry analysis on Damodaron. By the time you get, so Damodaron is a name of a person, but there is a website. Just by the time you just type Damodaron on Google, it will give you the Professor Damodaron's website, and then you can go to his database. And so he has gone ahead to do what we call industry analysis, country by country. So you can just go to your industry analysis and just say, okay, what is the cost of equity likely going to be in Nigeria, and then you pick that. So what we do most times is, when we arrive at our own cost of equity, we call this particular method build-up approach. By building up our cost of equity, we have this, what is Damodaron saying? So we try to, just for comparison reasons, and then we say, okay, this is why we have used this, and this is why we have used Professor Damodaron. And then when we arrive at this, I think by the time we have this, I think we are done with our valuation. So what we just need to do, of course, is to just discount. Of course, I believe we all know how to discount future cash flow to present cash flow, based on the fact that this is not, we are, some of us have experiences in in financial analysis and all that. So what we just do is to use our discount rate, our discount factor, and then use it on our cash flow to equity holders. Don't forget, we are doing cash flow to equity holders. It's a bank. We are doing cash flow to equity holders. And then after doing all that, we arrive at this, our value of 63 point something million naira. Of course, marketability discount is subjective. I explained that last week. Just like size premium, just like specific risk premium, marketability discount is subjective. If I'm to do this particular work, this particular client, for let's say this is a client's work, I'm going to apply a marketability discount. And the reason is because the marketability will be around 10%, between 10% to 15%. And the reason is because it's a new company. There is no, if I want to sell the shares of this company to people, it will be difficult to sell. Yeah, so most of the I've not applied marketability discount because of course will have to determine what is the discount we'll use. So if I'm doing it for a client, I'm expecting to put something around. Of course, I'll look at similar companies first. What has been happening with the similar companies? How trading their shares? How has it been? It has not been easy. That will determine the level of the amount of discount. Let's say in this situation, I'm applying marketability discount of 15%. Marketability discount of 15%. So that will bring my equity value. Of course, so this is what my equity value will be in that situation. Guys, I hope we have done justice to this. I will share this model, this particular templates, this one with Victor, and he can share with every one of us, so we can just apologize. I really apologize for trying to rush the class, but I believe by the time we sit down with it, and based on the explanation we've given, I believe it's easy and it's straightforward. So do we have any question?
Yes, I do.
Okay, let's go.
Okay, so my questions are two-pronged.
Okay.
Number one is when we talk about the getting the better for the company, and I was trying to find how do we relate to Nigeria. So how do we get the better for Nigeria, especially for a startup whereby it's Nigeria? So how do we get that better for that company?
So better is not country based, it is industry based.
Exactly.
Can you hear me?
Okay.
So it is industry based. So okay, let me just quickly share the screen with you. Done. Okay, let me stop sharing and share this particular screen with you. You see what I'm saying? This is equal to your screen. Can you see my screen?
Yes.
Okay. I'm not sure that's okay. That's not even what I even want to show. But this one, the one I'm presenting is just for the country-specific risk premium. But that's not what I want to show. I want to show the one for better. Just want to show you how. Okay. Can you see my screen?
Not yet. Yes. Yes.
Okay. Now, this industry beta that you're looking at, this Excel you're looking at, is from Damodaron. If you look at it, you can see 5 January, blah, blah, blah. So they always update this better. You can see that this thing, this information, better D ratio, effective tax rate, and what have you, they are based on industry. You can see advertising, you can see banking, you can see. So the one I've used, this 0.81, is from this place. So like I said earlier, you can just easily go to Damodaron and download this Excel as it says. And when you are doing your valuation, depending on the industry you are doing valuation for, let's say I want to do for valuation of an auto company, I can easily come here and pick that of auto company. Now, what you are saying, what the question you are asking would rather be for specific risk premium. Which is country specific. That's the, let me stop sharing this, and that is the first one I shared with you, which is this one. Let me know when you can see my screen.
Yes,
can you see my screen? Exactly. So now you can see that this one is country based. Can you see?
We can't see specific risk here.
See, this is it. This is country. Yes, this is country specific risk premium. That's the full name.
Okay.
So you can see now we can just easily this is also on Damodaran. This is like evaluation code, but it's a public information, so I can share that. So you can see that Damodaran is saying Nigeria has, where's Nigeria? You can see it's saying Nigeria has 5.4 5.4%. So there is a way they arrive at this country specific risk premium. And I think if you have opportunity of going into another class, I can start explaining how he arrived at all these figures one by one: equity risk premium, country specific risk premium. So if I want to apply a specific risk premium into my valuation, the valuation I showed you earlier, I will just pick this country specific risk premium for 5.4 and put it
Specific risk.
in my specific risk, and then of course my discount rate is expected to go as high as as high as 27 28%, which is still normal for banking industry. Do you understand?
Yes.
Okay.
Yes. However, also sorry, I was speaking with a colleague. Can you hear me?
Yes, please.
So and he was saying that that off record that there are certain Nigeria anyhowness. That was how you classify it to me. That there are certain things that happen in Nigerian market, not necessarily the global market, that which you also have to inculcate into. You have to discount in your valuation for Nigerian startup companies, like maybe 2%, 1%, because of how the Nigerian market is, or how the Nigerian ecosystem is. That if you don't add that or discount that into your valuation, that the valuation might actually be over, because it might be overvalued than what it actually supposed to be. So I want to confirm if that is true, or maybe it was just giving me fabu. So did you get that? Hello.
Okay, so I think his network just went off. So to kind of address the question you asked, right? One thing I want you to know is this: as a good valuation analyst, as a good financial modeler, don't ever question or don't ever query a particular approach or
Um,
the way someone has actually done his or her own stuff. As I said, it's all about estimate. Valuation is an estimate, which means you can either be wrong or right. You can either be fair or close to it. Even market itself make mistake, and that's why we have that element of sensitivity. So you are saying I have this risk-free rate of 12.75%, right? And you are building a sensitivity around it. Okay, let me sensitize it by a full 100%, while we still maintain that. What if we sensitize it by less than 50% or 70%, and all those things kind of comes in. Okay, Adedolam, can you hear us? Adedolam? Right, so that's where you have that element of sensitivity. The truth is we really cannot be 100% accurate. We are talking about the future, right? So we are discounting the future to today. So growth elements, and irrespective of the variable, the truth is you really cannot be 100% certain. And that's where most times a quarterly basis, new data just comes in to give us the true uh, clarity part of it, and you can always go back and do that adjustment and the whole thing. But to make provision for that, that's where we try to build in a lot of sensitivity around that. So don't ever think that, oh, someone said this that and that and the person is totally wrong. No, just try to understand the perspective of, of, of the person. Okay, right. Adedolamu, can you hear us now?
Sorry, Victor. I'm so apologies. I'm trying to do two calls at the same time. Apologies. Okay, so what was his question? He said somebody said.
Sorry,
Victor
Victor already gave me an answer.
responded. Yeah.
Yeah, he already gave me an answer. So thank
Okay.
you.
Okay. Yeah. Guys, apologies. I don't think I'll be able to take more questions. I really need to be on the client's call. I'm so sorry for that. Victor would just stand in for me in the moment, in the interim. Victor, please, over to you.
Okay, all right. So thank you so much for this. All right, this is such a rare um, uh, learning learning part of the modeling, that you get to see someone to teach us, right? Most of us are used to the one you just create your free cash flow, go straight to your terminal value, and straight like that. So in case where we might need to do that. Maybe we can have some other session where we just run through the generic valuation part of it. But this is more related to banks, all right, and you can always learn more about this on our own. On this note, big thanks to everyone and a big thanks to Adedolamu. Right, as I said, this is a very very busy man. You just have to steal him to have this session. So this is what we are going to do. As I said, we'll try and reach out to every one of us and let us keep us updated, so that maybe we can have a sensitivity and building of scenario session to just kind of close up everything. But officially, right, we've wrapped up our boot camp, and I'm quite sure you've been able to gain one or two things, right? Learning continues. That's the truth about it. And as I said, it's financial modeling. It's not a one-way thing. That yes, because of this one way must be done this one way. No, it's flexible, and that's why you need to understand that learning continues, or know different approaches. But before you start learning different approaches, learn the basic, understand the whole thing. So when you understand it fully, trust me, then learning this approach, how this person is doing it, it's kind of just flow. You understand why this person is doing it this way, why they've done it that way, here and there, and the rest. So a big thanks to everyone. Thank you so much for being part of this wonderful boot camp. So yes, I will try and get the template from him, and I will share that with every one of us, right? And to also get testimonial from us, how the training has actually been. So big thanks to everyone, and thank you so much for being part of this boot camp. We hope to have another one coming up very soon, as well. And we know you definitely be willing to support others, because you've actually gained one or two things from this as well. So big thanks to everyone. Thank you so much. And on this note, we'll be dropping the mic, and we'll be closing up our bootcamp program. So for the other part of the scenario and sensitivity, yes, we'll communicate that to us. We'll let you know if it will be free or if we're going to charge just a little fee for that. We'll keep you guys updated on that. So thank you so much. Thank you. I hope we've been able to share the most usefulness part of our resources, right, with every one of us for free. So big thanks to you. Please make sure this is more like a seed that has been planted. You need to nurture it so that it keeps growing. The more you build, the more you get better at it. Will not lie to you. I've worked on over 150 financial projects, and each project I worked on is always more like a learning curve for me, right, to also have different experience, different aspects to it. So that's why you can ask a question, and it seems it's easy for someone to relate with all your questions and the rest. So thank you everyone, and please let's make sure we enjoy the rest of our day. And on this note, we'll be saying bye for now, and hope we see ourselves very soon. So in case you have any comments, yes, I'll just stay back a while. I would like to hear from one or two of us before we wrap up the session. Once again, a very big thanks to everyone, and bye for now.
Yeah, thank you very much, Victor. We really appreciate. Thank you very much.
Yes, you're welcome. Thank you. Very fair.
Thank you. Adedolamu. Thanks to everyone.
Thank you for being part of the bootcamp.
Clear.
Thank you very much, Victor. Thanks for your time. Thanks for sharing this with us.
All right. So also remember, you get the recording of the session on my YouTube channel. So the one we had tonight,
Yay!
you can check that on the YouTube channel. It was uploaded yesterday. All right. So this one that we had
Oh,
today.
thank you very much.
So all right. Thank you everyone, and bye for now.
Thank you.